All right. Pounders. Let me see those comments.
Pounders?
Yeah, they're the Pounders. The compound fans. This is the Pound, and they are the Pounders. No? We got to work on that a little? Well, whatever. Very special happy birthday to two people very big in our community. One is Cliff Peebles, who's here every week on time, and the other is our very own Nicole. So happy birthday, Cliff. Happy birthday, Nicole. Guys, before we go any further, if you haven't yet subscribed, this is really important to Duncan. He's going to be in tears if we don't see a nice bump in subscribers tonight like we do every night. So make sure you go. Is that button clickable, Duncan? I always forget.
It's touchscreen.
It's down in the corner, in the right corner.
All right, but I can't see it. Okay, I got it. I get it. Make sure you subscribe. Happy 4th of July. Hope everybody had a great time. Hope everybody enjoyed the fireworks. I know Michael did. And the fun and sun. And now, checking back in on our bear market. See how things are going. The world is basically falling apart still. But we got to rally.
A word from our sponsors.
Oh, yeah, that's right. How could I forget?
Josh, did you know? So I don't know if CraneShares is known for K-Web. I guess it is, right? That's fair to say.
Yeah, that's their flagship. Whether it was meant to be or not, it definitely is.
Well, 21 was one of the weirdest years. K-Web was one of the weirdest funds. I don't think you've ever seen something like this. The numbers might not be exactly right, but it got cut in half or thereabouts, and a tidal wave of money came into it.
For those who are unaware, Michael's talking about the CraneShares China Internet Fund. So it's the most well-known way that people trade tech stocks in China.
I'm going to get to it. But did you know when did it bottom?
This year?
It bottomed a while ago.
I think it bottomed in March or April of this year.
Bottomed in March.
Yeah, it's been outperforming U.S. like NASDAQ stocks, large cap growth stocks here. I think there are political reasons for that and interest rate reasons for that. But we're going to talk about that later.
We'll get to it.
Okay. All right. But before we even start there, you're up first. It has been a horrible first half of a year. It is like truly one for the record books. And before Michael even walks us through why, the good news is we're all living through it together in real time. And as tough as it is, this will be one of those things that 3 years from now, 10 years from now, whatever, you'll be able to tell other investors, well, I managed my money or I traded through that period of time and I didn't panic.
Sir.
Therefore. Okay, go ahead.
You just stole my thunder.
Well,
I think it's like,
all right, go ahead.
It's easy to lose sight of the fact that we're actually in it, right?
Yeah.
Like
right in the middle.
We're all the way in it.
Yeah.
Stocks bottom today? Do we get a little bit of a bottom?
No.
You saw what was, I think
still going lower.
I'm not saying the bottom. We
right.
might have, I think we might get a little rally here. You know what was the number one performing stock in the Russell 1000 today?
Go.
I'll tell you. Carvana. Eric
Bang.
Jackson.
Bang.
Jackson. Stop with the bang.
How much off the low? And give it to me in points, you son of a bitch.
It was up 26% today.
Points?
Stop. 26% today.
Okay.
Wayfair up 18. Peloton up 14. Roblox up 14. Coinbase up 14. It's been a long, long time. By the way, these things are so beaten up. This Carvana 26% gain, you can't even see it on the chart. If you zoom out like 30 days.
No, but I do think we had Eric Jackson on the Compound and Friends at the bottom for profitless tech. And he gave us that one and he gave us Zoom.
What else?
And I
Zoom
bought Zoom.
Good.
I bought it. I bought it off of Eric's spiel, like we taped on Thursday night. Friday morning, the podcast came out, and I'm like, you know what? I think he's gonna be right on Zoom.
Zoom legitimately looks good. All right, so let's get to it.
I'm a Zoom stock genius. If I get out of it right here, I will have made money on this name twice, and that has not been easy to do. So, all right, go ahead. What do you got?
Let's start. John, I messed up the orders of this. Can we start with the S&P 500, which is the gray? There we go. John, well done. Very quick. All right, here we go.
Gross.
Worst. So here's what we're looking at, ladies and gentlemen. January through June, okay? We just lived through the worst January through June since 1970.
That's wild. And that's just in stocks. We haven't even added in how horrible bonds have been yet. Right?
So next chart, I want to look at the NASDAQ.
Yeah.
Thank you, John.
Worst ever.
Worst ever. How about that?
Ever. What is the NASDAQ back to 85. Okay, fine. Worst ever.
I think the worst one prior to this, I can't remember if it was 01 or 02.
Doesn't matter. Nobody watching this other than me was alive pre-1985, and even the people that were not trading.
Stop with this nonsense. You act like you're like 70.
I'm getting up there in years, son. And 1985 is enough.
So down 30+% January through June. And this is adding insult to injury. So we know, actually, before we get to bonds, let's look at the venture one. So I know this is like a hypothetical index. I don't really know how this is constructed, but venture year to date is down 55%. That is probably worse in reality.
Oh yeah,
55.
Definitely. That's just the things that are being self-reported.
The further out you get, the worse off it is. ETH was down 70, whatever it is. It's disgusting. All right. In an environment like that, if you knew nothing, you would think that bonds did like, I don't know if you would think that they would rip, but maybe okay.
Yeah.
Maybe okay.
Nope.
Nope. Actually, the worst of all time.
Pop that chart. Chart on.
Worst. Nope. First one. The first one that I asked you to skip. There we go. Thank you. Worst start to a year. I mean, I'll take that 1788 with a grain of salt. Come on.
1788, my ass.
So, all right, your risk assets kicked you in
Who is this? Is this Deutsche Bank?
And then your risk off assets kicked you in the you-know-what. It's Deutsche.
Is that Torsten Slock?
Sure.
No, but is it? I don't know. I lose track. Okay, the worst first half of a year for 10-year Treasury or proxy. What's the proxy back to 1788? Did bonds take the form of boxes of muskets?
IOUs.
Fine. Okay, fine. But so what? Like, let's even assume it's directionally right. The worst first half to a year for 10-year Treasuries in 300 years. All right, I'm bullish on the bond market, by the way.
Well, the interest rates have come down, which is nice. So I don't want to say if you survive this, you can survive anything, because it's been a bad 6 months. It could get worse, obviously, but you've been battle tested. Things have gotten pretty bad. The good news is that, as always, if we can zoom out, if we can extend our time horizon, we know intuitively, empirically, that returns on a go-forward basis get better from here. Doesn't mean at the bottom's here, but they get better. So let's look at this this colorful chart that I created. And I know it's a lot, but all that you really need to pay attention to is let's just isolate one column. Let's isolate 3 years later.
The red is when it's really hot, and the green is when it rains?
No. It's the opposite.
Okay.
But just look at 3 years later. When you're 0 to 10% from the all-time high, which is 60% of the time, returns 3 years later are 27% on average. 10 to 20, for some reason, it gets a little bit worse. All right, I picked the wrong column. But anyway, the point is, the lower you go, down 20 to 30%, 3 years later on average, you're up 29%. That's an annualized 6%. The longer you go, the more you zoom out, the better it gets. So I'm not to minimize your pain or say that this is the bottom or close to it. But we know if you can endure, you have to survive. If you can survive, you're going to be fine.
Chart back up. Chart stay up. You know what the real column that matters the most is, though, right?
10.
10. Yeah. And every one of them is at least a double. Every single time horizon is at least a double. And that's even from being 0 to 10% down. What's interesting is, though, being down 50% doesn't materially increase that.
Yeah, so I would just take that with a grain of salt or sand or whatever the hell, because that happened like twice.
Fine, but I'm just saying, like, that didn't mean you tripled your money if you bought down 50. So
you know what I looked at today for a sign of a reversal, but this is not a reversal sign because it wasn't that extreme. It's just a sign that bear markets suck. So I was looking at, all right, just grasping. I'm grasping. I'm looking for some hope here, Josh. How many times has the NASDAQ 100 been below its 200-day moving average, so in a downtrend, opened down more than, was down more than 1.5% at its lows, and then closed up more than 1.5%, We've done that 3 times in the last like 3 months.
Yeah.
I thought that was going to be sort of rare. We did it 3 times in the last 3 months. The last time it happened prior to this was 2015, but in 2008 and 2009 it happened like half a dozen times.
Can I tell you something? There's just no panic out there. There's a lot of pessimism and there's a lot of negative sentiment toward the economy and inflation and Biden, and like there's like a lot of the polls are reflecting what you would refer to as misery, but there really just is not that much panic.
All right,
I think we did one VIX day at 45, and that is just not enough. And
hang on,
sorry.
I would disagree. No, I disagree vehemently.
Okay.
We don't need a panic to bottom. We don't. That is not factual. People are looking for it. You can bottom with misery. It might take longer. But where does it say in the rule book that we need to have a panic capitulation? And by the way, dude, these stocks are down 80%.
It's not in the rule book. It's just in my soul. When I speak to people, Michael, I am not spending my entire day with my nose in an Excel. I am out among people. And I have to tell you, the people that I talk to.
This is a joke. I know who you talk to. You don't talk
It's not a joke.
You talk to me.
It's not a joke.
Who do you talk to?
Of course I talk to you. But I don't use you as I don't use you as a contrarian
Who are you talking
signal.
to?
I think you're very bright.
Let's hear it.
I talk to people that I have known in this industry for 10 years, 15, 20 years. They're not even particularly smart people. But like I sent one text out. I'll give you an example. I sent one text out over the weekend wishing a friend of mine happy July 4th, which turned into a market conversation against my will, but it did. But he's like a reliable, like, oh man, this is so bad. He's like, yo, did you hear Carmen Electra is on OnlyFans? Like he pivoted. He segued. Like we maybe had 2 exchanges about the market, and he's on Carmen Electra, who I think is doesn't matter.
Yeah,
but
this is great data. This is great.
No, but my point is, I need this guy to be like, yo, you think this is gonna get better, JB? Like, what do you think? I'm not getting any of it, none of it, and normally I will. So all I'm saying is. I'm not saying it needs to be a panic. I'm saying like it almost always is. Like just it almost always is. So I still think that's yet to come. And I don't know what will cause it and I don't know why. And I'm not saying don't buy anything, wait for the panic. I'm just like, I'm ready for that shit. And by the way,
yeah, I think everybody wants a panic. Everybody wants like a VIX spike.
Fine.
Like,
historically,
October
September, October is a pretty good time for that historically.
All right, so we've got some more room to run before the bottom falls out.
I really feel that way. But all right, this is my segue. I do agree with what you have been saying for a while now, that bad news is good news. And I wrote about it this morning. Actually wrote this.
Wait, Ben and I were laughing today. What if we find, because we haven't seen, what I'm saying, like, we haven't really seen bad economic prints yet. We've seen like a few here and there. What if we get bad news and it's just fucking bad news? And we get bad news and the market's down like 8% on the day.
Well, no. We kind of, wait. So this is the whole point. We kind of are getting bad news and the Dow is opening down 500 points as a result of it. Or I'll give that to you in percentage later.
Go ahead.
But I'm saying we're kind of, that is what's happening. Like bad news is being treated like bad news at the open.
Right.
But then, and you've made this point, and I think I have, probably not as well as you have, but like, how many days in a row can you tell people the economy's shitty before they're like, all right, I get it. I'm still buying a stock. Like that's what happened today. That's literally what happened today. And if you're telling me that we're going to go into this world where GDP growth is back to 1%, or God forbid worse on an annualized basis, then guess what? They're going to want growth stocks again. You saw what led the market today? Profitless tech, FANGs.
We just went over this, Carvana and Peloton.
No, but they bought the shit out of Amazon. Amazon is like rocketing off that bottom now, 2 days straight.
And
it's 2 days. But
interest rates are pulling in pretty big time.
Right. So like it's good news. Bad news is still bad news. But then for a big part of the stock market, also it's good news.
Because
and that's really interesting.
The only thing that matters right now is inflation.
Okay. Let's put this chart up. So I have very skillfully not only called the top in employment-related inflation pressures, which I think I am already vindicated on, but in housing-related inflation pressures as well. I have just been running the table this entire spring. And
housing hasn't turned yet, by the way.
Yeah, no, it literally has. It's like plunging everywhere except for price. Price is next. But
Okay,
No,
I'm
no,
just
no.
saying, it hasn't changed yet.
Mortgage applications plunging, existing home sales plunging, new home ssales, forget it. It's one thing
I
after
agree.
another.
I'm just saying median price is still rising.
Very stubbornly, and rents are still high too. But I think I'm going to be right on both of those. Those two might take a little bit of time, but I think I have it. The third thing now is commodity prices. John, can we pop this chart? Okay, there's a Wall Street Journal chart, and I just want to get into the numbers here really quickly. Natural gas prices shot up more than 60% during the second quarter before falling back to close the quarter 3.9% lower. U.S. crude slipped from above 120 to end around 106 for the first half. I think it went lower today too. Wheat, corn, soybeans all wound up cheaper than where they were at the end of March. Cotton unraveled,
Crazy.
lost a third of its price. Benchmark prices for building materials, copper and lumber, dropped 22 and 31% respectively. A basket of industrial metals that trade in London had its worst quarter since the 2008 financial crisis. So this kind of dovetails into bad news being good news, right?
Absolutely.
So what I said in my post this morning, like normally we would not be cheering a collapse in commodity prices that takes place this quickly. We would say, oh, that's a really bad sign. These aren't normal circumstances. This is demand being destroyed in part by some of the stuff the Fed is doing, and then in part just by the realities of the global supply chain slightly getting better.
One more thing. Hey, what the hell is going on with the dollar? Why does it look like a meme stock?
Yeah, it's weird. It's weird. Because I think I don't really know.
Good answer. I know, seriously, I don't know either. John, throw up this chart.
I think
So DB, this is I think the biggest commodity ETF by assets. So over the last 10 years, these red dots are the only 6% daily declines. And we got one today.
Right. Do you understand that the commodity indexes have like 30 different contracts in them? Like it's not like it's all oil or it's all copper. So this is like everything dropping at once. What could make that happen? Well, let me share this with you. Also from the Wall Street Journal. JP Morgan Chase commodity strategist Tracy Allen said about $15 billion moved out of commodity futures markets during the weekend of June 24th. It was the fourth straight week of outflows and brought to about $125 billion, the total that has been pulled from commodities this year, a seasonal record that tops even the exodus in 2020 as economies have closed. So year to date, more money has come out of the commodities market than during the pandemic. So
That's weird, very weird, because commodities were the only thing working in 2022. So
took
explain
profits.
that. Explain that.
I will explain it by telling you that liquidity tightened. They took profits. I don't know. Money went into the dollar. Money came out of
Don't do this.
out of
money
risk
came out of.
and went risk off.
You see copper, by the way,
Yeah, it looks gross.
crashing. So commodity DBC is 18% off its high. It's about to be in a bear market itself.
Bro,
What a
yeah.
world.
No,
A world. All right, let's move on. Are you good?
I just want to reiterate, like I am nailing these. I am nailing these inflation top calls, one category after another. It's really impressive. Okay, go ahead. Well, somebody has to say it.
You're ridiculous. All right,
I have these posts published at specific days and times. Like these things do exist. There is a record of this. Okay, go ahead.
Okay. Matt Klein. I always get my Matts mixed up. Matt Klein.
Matt Klein's the handsome one.
Actually, we have the other Matt coming on TCAF.
Yeah, also handsome.
All right. Americans earned about $155 billion more in May 2022 than they did in January 2020, which is interesting. We're earning.
Why do you think this is? When you say earn, is this income from salary or is this just everything?
This is not inflation adjusted. That's not even the point that I want to make. The point is this.
Okay.
He showed a chart, the contribution to change in nominal U.S. disposable personal income. On the red in the bottom, you've got a lot of tax money coming out. People have gains, as we know. But the only thing here that really, really stands out that matters is look at March 2021. Oh, dear my.
Yeah.
We know what
What
that
is
is.
it? What the hell is that?
That's Biden's stimulus package.
Oh my god.
Oh my god.
It's like 3 years of
Oh my
more. It's like, yo, that's like 4 years worth of employee pay. Like, am I reading this right?
Oh my goodness.
No, it's not 4 years. Because this is in months, so you can't tell how many years. It's like 4 months of employee pay. Let's put it that way. That is, I mean that is wild.
Look at that thing. All right, so let's talk about some more charts.
Well, listen, wait, can I say one thing?
Yes.
He really wanted that plan. It's the only thing he's gotten done since he became like really. And I'm not a Republican, everybody. So like, just calm. I'm nothing. Okay, I'm nobody. I don't even do politics. But like, this was the one thing that he really wanted to accomplish, and he had a push in the Senate and a majority in the House. And this was the one thing he wanted to really do. I know he wanted to do more, but he like got this one thing done. And it turns out to have been a bomb that he planted under his own desk, you know, in terms of the economy. Like, it did not accomplish, I think, what he thought it would. He didn't get any credit for it. A lot of the people who were on the receiving end of that money hate his guts right now.
And now he's getting blamed.
And now he's getting, rightly or wrongly, some of the blame, all the whatever. He's like not winning as a result of passing that legislation. He would have been better off not doing it at all. But then the narrative would have been he didn't do enough. So I don't really know what the right answer is, but this is not a great situation for the incumbent president going into these midterms.
The part about all of this that's so interesting is, let's show up the next chart, John, please. From JP Morgan, they're showing the percentage change in median checking account balances from 2019. And on top is the bottom 25%. And this segues nicely into the next chart, John, please. This quote comes from Mark Zandi from Moody's Analytics. He said, the bottom 20% of earners was the only income group that didn't draw on their pandemic savings in the first quarter of the year. These are folks working in leisure, hospitality, retail, and healthcare. Strong wage growth has allowed many of these workers to continue to save. All right, this is important. I understand that this is only for the first quarter. We'll see what happens for the second quarter if inflation keeps up, blah, blah, blah. Chart off, please. Isn't inflation supposed to hurt the lowest income the hardest? And they're the only group that didn't draw down their pandemic savings given all of the stimulus and
because I think the second part of that is the key thing, which is that the biggest beneficiary of wage growth in this particular moment as a result of government stuff and whatever is that group. And it wasn't the billionaire class did great, but there are a lot of periods where they do great. And their money is not even W-2 income, so it doesn't even matter. But I'm saying like the upper middle class did not win disproportionately versus the bottom 10, the bottom 20. Like the bottom 10 and 20 got the biggest percentage gain as a result of all these programs, and also as a result of how badly they're needed right now.
So I could hear people in the comment section yelling, because it is true. Once they do draw down their excess savings, they will be hit the hardest. There's no doubt about that.
Well, especially if energy stays up, because that is the biggest swing factor in their monthly budget. Like, they roughly know what it costs to eat lunch. They have a rough idea of like what their rent and operating their house, but like gas prices is the swing factor, and air conditioning and heating. Like, that's the thing that is going to really hit them the hardest if it stays this way.
People don't live core inflation.
That's right. But that's really interesting. The fact that we even had people with excess savings was miraculous in and of itself. I wanted to bet the sell side indicator. So
I've never even heard of this thing before.
Oh, this is awesome. So Savita Supermanian has been keeping what is that, a vacuum cleaner?
Yeah, Robin. What is this? No respect.
I mean, honestly. All right.
Unbelievable.
Tell her to do the windows. Savita Supermanian at Bank of America, one of our favorites. We read all her stuff. So she's been keeping this thing called the sell side indicator, which is looking at the percentage of a portfolio that strategists are recommending be in equity. You follow me on that? Mm-hmm. Okay. All right. So let me just read this. Wall Street became more cautious in June. Can't believe it. As the S&P 500 officially entered a bear market. Our sell-side indicator, which tracks the average recommended allocation to stocks by U.S. sell-side strategists, slipped lower from 55% in May to 54.6% in June, marking the first time the indicator has fallen for 6 consecutive months since 2008. The sell-side indicator is one of 5 inputs into our year-end S&P 500 target. Indicates an expected return of plus 14% over the next 12 months, which would yield 4,300 for the S&P 500. This is the end. Historically, chart off, when the sell-side indicator was at current levels or lower, subsequent 12-month S&P 500 returns were positive 94% of the time versus 83% over the full history. The median 12-month return was 20%. So anytime the sell-side indicator, meaning the percentage of a portfolio that Wall Street strategists are saying should be stocks, has gotten to where it is now or lower, S&P 500 returns were positive almost all of the time 12 months out. And again, the median 12-month return was 20%. So they've got more than one input in how they come up with their price target, et cetera. But this is a fairly big, in my opinion, and fantastic contrarian indicator that the Wall Street strategists have ratcheted down their bullishness on stocks to a great degree. So I thought that was kind of cool. And Savita's like a dream guest for us for the Compound and Friends.
Have you invited her?
She's in I think she's in London, but we'll do it. We'll make it happen. Maybe we'll go there.
There is a possibility. So on the one hand, you could say, okay, and I've said this: if we don't have a recession, stocks are a screaming buy, like right here, even if they could go lower.
This is all a time. It's always a time frame conversation.
Listen, I made the point that
they're definitely a screaming buy if you're watching this show because you're probably 33.
Also,
100%.
If you bought stocks in October 2008, 30% before the bottom, and you gave it enough time,
yeah,
no, your stocks were a screaming buy.
Yes, and they still went lower.
Right, okay.
Yeah.
What if this is, we're overthinking this, or maybe we're not overthinking it, but what if this is simply just stocks are re-rating to normal times? And inflation.
I've never been accused of overthinking.
Higher interest rates. We're just unwinding all of the excess over the last couple of years, and that's really it.
We are, and lightning fast.
Yeah.
Lightning fast. What do you have? You have stock downgrades here?
Well, so I was getting excited about this.
Yeah, let me say it.
Because we've got JP Morgan with some pretty big downgrades, chart on, if you will.
Are these new?
This is from a week ago, I believe.
Okay.
They took Alphabet. It doesn't even matter. But the point is, look at all those names. Alphabet, Amazon, Facebook, Netflix, Snap, the whole list of them, the whole lot of them.
What have they been upgrading on the other side? Like probably Chevron, Exxon,
Energy. That I don't know.
Phillips, Occidental. Right.
I got unexcited because I saw this tweet from Walter Deemer. He said, "Oh dear, none of them is expecting a down second half. We're looking at Wall Street strategists for the end of 2022. Not a single one of them." And listen, I understand if I'm a strategist, I'm not saying stocks are going lower here. Excuse me. In addition to this, bottoms up estimates are not coming down yet across the board. So I showed JP Morgan, but in aggregate, they're not coming down. So, okay, this is interesting. This is from FactSet. Over the past 3 months, analysts lowered EPS estimates for the second quarter by a smaller margin than averaged and increased EPS estimates for the full year. So
in fairness, the analysts aren't being given guidance from the companies they follow, indicating
immediate
that they
20% discount. Immediate.
What?
Immediate 20% discount. Yeah,
What's immediate?
They're not getting clarity from the companies because they don't have clarity. Boom, 20% haircut.
Right. But I'm saying on the earnings side, they're not being given guidance that would would make them want to run out and slash earnings expectations across the board. Like, we're just not there yet.
Indiscriminate. Cut it. All right. So the Q2 bottom up EPS estimate decreased by 1.1%. This threw me for a loop. I didn't realize this. In a typical quarter, analysts usually reduce earnings estimates during the quarter. So basically, analysts are overly optimistic is the TLDR. During the past 5 years, the average decline in the bottom-up EPS estimate during a quarter
we had the wrong chart up.
Hang on a sec. Was 2.4%. That's the average estimate knockdown. 2.4%.
Wait, so time out. So the analysts always start off a little bit too high.
Correct.
And then on average, but by the time you get through the quarter, they will have come down by 2.5%?
Yes.
Okay. What is this? The bottom-up earnings per share?
Now they only came down 1.1%. All right, so now let's go through some charts.
Okay.
Let's just cycle them through, John. Cycle. All right, we did this one. So this is showing the price in the dotted line and the EPS estimates tracking.
On the left Y.
That's the dark blue.
So what we're saying is that, all right, so the stock market has way front run any decline in bottom up earnings for Q2 22 well in advance of it actually happening.
Both these things can't be right, can they? Unless it's
no,
just
the
unless
truth
it's
could
just
be right
simply,
in the middle.
Unless it's simply a re-rating, as we've been saying, and maybe earnings don't come down that much. Possible.
It would be very surprising, and it's still early.
Things are weird. Let's look at S&P 500 sector level change. Here we go. This was in the second quarter, and maybe not surprisingly, at least it shouldn't be surprising. You have energy up top, consumer discretionary in the bottom, and that's all you need to know. That's all you needed to know, I should say, about what happened in the second quarter.
And those two things are opposing forces. Consumer discretionary is a direct beneficiary of lower energy prices, and then the same works in reverse.
But can I just point out that I don't want to say this was not necessarily a coincidence. You're right, directionally. But consumer discretionary names got killed independent of demand destruction. That was all inventory build.
Yeah, which makes perfect sense. Which makes perfect sense because it's the weirdest period of time ever. And we all always said that there's just no way you can have these extremes in like durable goods orders in 1 year and not feel the resulting washout in the following year. So a lot of this is also like the versus comps that are just unrealistic.
Anyway, so analysts, at least on earnings per share, are just not there yet.
Okay. Can I pitch you a sector?
Sure.
Okay. The money has to go somewhere.
No, it doesn't.
No, it does.
Nope.
No, it does. Nope. All right, just follow me on my premise. It does. So if the money does have to go somewhere, why not healthcare? Why not healthcare? So I don't even know that I can.
He said it twice. Now I believe.
Well, just hear me out. It's sort of defensive, but then sort of not, because biotech has been one of the hardest hit segments of the overall market, and biotech is a fairly big weighting within XLV. So you could see biotech here in orange at the very bottom. This is year to date, down 30%. But then there are other areas within the healthcare space, chart back on, that really have acted as defensively as they should. So you see like hospitals, you see medical devices have done a little bit better. Obviously pharmaceuticals in purple, down less than 4%. Amazing year to be in those names.
I'm looking at XPI. That's a good looking double bottom right there. I'm zooming out on my own screen.
So here's what I would say. Let's say people want to be somewhat defensive, but they don't want to rule out the possibility of growth stocks having a resumption because rates are coming down or have come down. Healthcare might be the right answer. So it is the fourth best performing of the 11 S&P sectors this year. It's only down 9%, which is a walk in the park compared to what you've experienced elsewhere. So I don't have any more charts, do I, John? I have one more.
Wait, so what's the pitch?
So I'm pitching this for the second half. Pay attention. So these are the four, what I would consider to be the four defensive sectors in the market. Classic defensive sectors. Purple is staples. I don't know that energy would classically be defensive, but it's defensive this year.
Right.
Utilities.
Utilities got murdered today.
Yeah, because
Rates.
people have been hiding there, and they don't have to. All right. Anyway, I was thinking XLV. You have a dividend yield of about the market 1.52 versus 1.61 for the SPY. But if you were to overweight toward pharma or managed care or whatever, you would have a much higher yield. Expected earnings growth is about 10%.
Or whatever.
Well, I'm saying like how defensive you want to get versus how aggressive.
Okay.
Anyway, just thought this might be an interesting idea for a sector idea for the second half. I have a couple of decent looking charts, or some, not even really, but the best performers.
I'm looking. Go ahead.
Let's go.
I'll pull them up as you're talking.
You sound like you're in a rush to go help out with the vacuum, Michael.
I'm
Slow
not in
down.
any rush. I've got nothing but time.
All right, Bristol Myers.
I'm liking this.
Dude. This is year to date.
Okay, looks good.
You imagine this was a 10% weight in your concentrated equity strategy? You would be bowing down every morning.
The stuff is very good.
Merck, this looks even better. 20.5% year to date is total return, I think. Yeah. Next one. How good does this look?
I gotta be honest. I'm more of a Bristol Myers guy than a Merck guy. Merck's a little bit too sloppy for me. I like Bristol.
Okay. What do you think of Eli Lilly? Ooh.
LLY. Hang on.
Dude, this chart is exquisite.
Yep. This is a winner.
This one is like the analysts love the stock, but it hasn't done as well. AbbVie.
Now you know what I like about Eli Lilly? I like that pipeline, Josh.
Yeah, quite a pipeline. Last one, Cigna.
Okay.
Cigna. So
CGNA?
yeah.
What's the
No,
sticker?
I think it's CJ. No, is it? I don't know.
Cigna.
CI.
huh?
This is a gigantic company. So, but like this thing, if you were overweighted to this area of the market, yes, you took some pain in biotech, but some of these names, these large cap names, really have held up well. All right, chart off.
I'm looking at XLV. So what's killing this thing? It's got to be the biotech. Which, by the way, XBI is looking strong.
But XBI, all right, but wait, back up. XBI is not in XLV really. It's more like IBB. Like IBB is like
so like Regeneron and
gigantic biotech. These stocks have been as bad as
Regeneron looks like shit.
Dude, these stocks have been as bad as regular tech, and they shouldn't have been because they're not economically cyclical. They're not fucking stay-at-home stocks. There really is no reason why biotech has been treated the way it has, other than people needing to liquidate it.
There probably is. Oh, we haven't talked about Moderna, but Biogen. What the heck happened to this name?
Dude, Moderna trades more with the ARC stocks than with the biotechs, and Moderna might have bottomed. I hate saying that out loud because you know it hasn't. But it did some substantial bottoming work in June.
Moderna and Biogen look very similar.
But wait, do you see how the low in March and the low in June on Moderna are pretty much the same?
Identical.
Could be about. All right, we're done. Duncan, come on up. Let's do some viewer topics. Where are you, handsome? There he is.
Hey guys.
Oh, you're in Manhattan today. Look at that.
Yeah.
All right. What are we doing?
Okay, so just a reminder again, be sure to subscribe if you're not subscribed. We appreciate it. We have almost 1,400 people watching live right now, so great turnout tonight. Thank you, everyone.
Thank you. We love you guys.
Yeah. So up first, we have a question from Charles, which is...
Brother, you can't do a bang. That's for the doctor. That's
right,
John
boom.
Najarian. Do boom.
Can I do boom?
Is that where that came from? Okay, I didn't know.
Did it?
John does that.
I just picture like a comic book. It's like bang.
Boom.
Okay.
All right, let's go.
So
You're
up
right.
first,
He does do that. I'll stop. Okay.
we have a question from Charles. When discussing the market, I feel like you guys typically focus on the S&P 500. Is this what you take to mean the market? And with all things being equal, is this where you'd advise the average person to invest?
It's because Michael's a major size queen. We only follow the largest companies. And I asked Sean to take a look at this.
I have love for all my style boxes.
You do. I asked Sean to take a look at this for us so we could give a good answer. And it looks like the market cap of all stocks traded on U.S. exchanges without duplicate share classes is $51.51 trillion. The market cap of the S&P 500 is $34.3 trillion. So 66% of the market is in the S&P 500.
There's no way that's true.
You think that's wrong?
Yeah.
Sean, you're fired.
Wait, what was the 50 trillion number?
Clean out your remote desk.
What's the 50 trillion number? 50 trillion? No.
Let me back up. The market cap of all stocks traded on U.S. exchanges. So this is Russell 3000, I guess, or Wilshire 3800, whatever it is. Okay, is 51.51 trillion. The S&P 500 is 34.3. So the S&P 500 makes up 66% of the total market. What would you guess it would be?
90.
You would say the S&P is 90% of the U.S. stock market?
Remember when Apple was bigger than the Russell 2000?
Yeah.
Should we bring Sean in to fight with you about this? Or
No.
He could be right. We'll take this offline. He could be right.
But I told him to go to you on this.
He did.
And what, you blew him off?
I didn't get to it.
The worst.
I
We
didn't
love
get
you,
to
Sean.
it.
We're just teasing. All right. So you didn't want to give the Charles a good answer. That no. Why do we focus on the S&P? Tell him.
Because that's where all the action is. I mean, that's where Facebook and Amazon and Microsoft and Costco and Home Depot, and that's where it all lives. Is it? I think it's fairly representative of the overall market, right? What do you think? I mean,
who gave us this? Like, this was a good. I thought this was a good take. It's very representative of just like corporate America. Because like so much of the profitability and the revenue, et cetera, is coming from obviously Apple and Exxon, right? But it's not really representative because like these are the 500 best companies on earth. This is like saying players in the NBA are representative of the basketball skills of Americans.
If you were
they're obviously not.
If you were only looking at the S&P 500 in the second half of 2021, you would have no idea, not a clue, that a lot of the high beta tech growth names were absolutely blowing up.
Yeah, right? They're not even in it. They're not even in it.
I think ARK was already in a 40% drawdown when the S&P was peaking in late 2021.
Yo, as big as some of these companies were by market cap, like Snowflake and Zoom, they were bigger than like half of the components in the S&P, but they just weren't in the index.
I mean, Tesla only just got added last year.
That's right. So there was a lot of pain being felt in large cap stocks that just weren't in the S&P. So
but to the viewers, to Charles's question, would I recommend that you only own the 500 largest stocks in the United States? Absolutely not.
yeah, when we focus on the S&P 500, it's for the purposes of trying to capture the essence of what's happening in the market or the valuation, but it's not saying that this like is every stock. We're really just talking about the stocks people own.
Plus, if
this is
you're
what
going to do
people
anything, you own the 30 Dow stocks and you call it a day. That's what you do.
All right, question 2.
Yeah, I feel like
I should say topic 2.
The last few years, I feel like a lot of young people have paid more attention to the NASDAQ.
NASDAQ. That's right, Duncan.
That's been fun.
Yeah.
Yep.
So,
And what did they learn?
RIP.
All right, go ahead.
Tons of fun.
Okay. This question's from Brennan. We hear all the time that a bear market is when you make your money or be greedy when others are fearful.
Makes me think of Step Brothers.
But I
was
never
one of them
hear a
Brennan?
percentage or a
Will
recommendation.
His name is Brennan in Step Brothers?
Brennan. Yeah.
Brendan?
Brennan.
Okay.
What was the brother?
All
What was
right.
the dickhead brother's name?
Oh, that
You have a
guy's
better
great.
memory than mine.
That
I
guy's
don't
good.
remember.
He was in Severance.
Adam Scott. Yeah. What was
Yeah,
his-
Adam Scott is so good.
He's so good in that movie.
All right. Sorry, I interrupted.
He's hilarious. Oh, okay, yeah. We hear all the time that a bear market is when you make your money or be greedy when others are fearful, but I never hear a percentage or a recommendation of how long to be aggressive. Should we be doubling or tripling our normal DCA amount? Should we invest aggressively until we exit bear market territory? Are there any guidelines you would suggest?
We're done when I say we're done. You will invest aggressively until you fucking run out of money.
We've done all the work on this, right? When to buy here. It doesn't matter. I'm not saying it doesn't matter, but you will not know ahead of time. There's no rules. But to Josh's point, buy as much as you can and without being irresponsible. No leverage. Unless you've got like
What else are you gonna buy? Food and shelter? What are we talking about? Here's what you do. Listen to me. NOBL. These dividend aristocrats. Okay? These are companies that for 25 years, longer than most of the people you know, Brendan, have been alive.
It's Brennan. You're pitching
Brennan.
dividend aristocrats here?
I am. Dividend Aristocrat is defined as a company that for 25 years or longer has not only paid a dividend, but has grown their payout.
General Mills.
There's like 60 of these companies.
Yeah, these are
There's like
American
not a
names.
lot. And the lists, there's not that much turnover.
Unilever.
We don't get new Dividend Aristocrats every year. If you're on this list, you are an OG. You are a gangster. And you have been through like 6 recessions minimum and have not only survived, but raised your payouts or maybe even your profitability. This is what you do. It's a 35 basis point expense ratio in the ETF. I'm not like endorsing an
pitching
ETF,
this?
but I'm saying something like that. Don't ask me how long should I be aggressive. That's not like I'm telling you buy Cathie Wood. I'm just saying like those companies will be fine. The stock prices will not. They'll go up. They'll go down. You'll feel like an asshole sometimes. But I'm just telling you, you just do that. And then the second part of this is lose the password. Put $100,000 into that and then lose the password to your brokerage account. And then in 3 years, like call customer service, get logged back in, and then call us and say, thank you, Josh Brown. I really appreciate you telling me to be aggressive and then like not even think about it because that's obviously the right answer when you're a young person.
And Unilever is not an American company. I'm sorry about that. What is it? Procter & Gamble? Colgate?
You want to know what's in this? You want to know what's in this thing?
Yeah.
Hold on. We're not getting, chill. We're not getting any money. What is this? ProShares, S&P, Dividend Aristocrats. I'm using this as an example. We're not like
these are boomer stocks.
Not a recommendation.
Consumer staples.
No. We're not fund wholesalers. I don't give a shit what anybody else does, by the way. I never give anyone advice. But this is Next Era Energy, Brown-Forman, Albemarle, IBM, Exxon, Genuine Parts, Air Products, Colgate, McDonald's,
Never heard of
Johnson
half of
Johnson,
these.
Kimberly
Don't like
Clark.
these.
These are like the most boring, like nobody owns these stocks individually unless they work at the company. Like nobody owns Genuine Parts.
All right, let me do you one better. How would you like a group of 30 stocks, 30 names? None of them have ever made money. You've got 17 consecutive quarters of hemorrhaging cash flow. The ticker.
Oh my God.
Are you making fun of me because what I'm saying is so obvious?
Currently in a 75% drawdown.
What is? Oh, you want to know how this one is done year to date? Just for the hell of it?
Down 4%. No, it's got to be down more than that.
No,
down 9.
It's worse because it's every sector.
Yeah. All right.
Year to date, down 11.2 versus 19 for the S&P. I mean, like this is what you're supposed to be doing.
Are these what you would call low beta names?
These are consumer staple stocks. You might as well own XLP and save 30 basis points.
Take $100,000 and put it into that, and never log in again.
Don't do that.
Just do it. Just do it tonight.
Don't
All
do
right. All right. That's it for viewer topics. Great job tonight, Duncan. Great job, Sean. We're just kidding with you. Happy birthday, Nicole. Thank you, John. To everybody who came out for the live, we love you guys. We appreciate it. If you haven't subscribed yet, you know what to do. Tell your friends about the show. We will see you next Tuesday. And remember, tomorrow's Wednesday, all new Animal Spirits podcast. When you wake up, video later that day. We'll see you soon. Thank you.